Welcome to Stocks in Translation. I'm Jared Blikre, hosting alongside the voice of the people, Sydney Freed. Thank you for tuning in, and a few housekeeping notes. Be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, wherever you get the podcast. Very special introduction today for Kevin Mahn. He is the President and Chief Investment Officer at Hennigan & Walsh. And Kevin, you were one of the first guests I booked as a producer way back in the day at Yahoo Finance, 2015. Midday Movers, you guys might remember the best 15 minutes on television.
Just a couple years ago. I was only 12 at the time.
Yes, you were doing.
In case you're trying to guess my age.
You were quite prodigious. Today we're going to be talking about a bunch of different things. The Fed, and that leads to our phrase of the day, which is dot plot. And we're going to take a peek at the Fed meetings and their drama. This episode is brought to you by the number 7. That is a number of industry groups besides semiconductors that have returned over 20% this year. So that means that the rally has broadened, and we're going to tell you guys who is vying for that number 2 spot. Before we really get in, we'd like to get your overview of the markets right now. We've got stocks relatively high, some at record highs, but there's always fears, worries, doubts. Fed is easing though. How are you talking to your clients about this?
Well, as a portfolio manager, I would start by saying the short-term outlook, at least for me, is cloudy, but the longer-term outlook becomes much clearer. And there's a couple statistics that allowed me to have that optimism as I look a little bit further. Historically, the Fed has cut interest rates 12 different times when the market was at or near record highs, just as they are right now. And Jared, in all 12 cases, the market was higher 12 months out by an average of 14%. We also know that going back to 1946, there have been 12 bull markets. The average length of those bull markets is about 5.3 years, with an average cumulative return of 180%. The current bull market is only 2 years old, with a cumulative return of about 64.5%. So if history serves as a guide, and of course this time could be different, but we have at least 2 more years of this bull market to hit historic averages, which ties in nicely with that Fed's 2-year outlook for cutting interest rates.
Yeah, 2 years here. My issue with the 1 year, we look back to 2007. That's one of the big ones in the example. All right, so the market peaked in October or something of 2007. And then a year later, it was still doing pretty well, but the stuff had not really hit fully the fan yet. So when you look 2 years out, we had a big decline. I think market finally bottomed in March of 2009. So it took a while for all that negativity to kick in.
Yes.
Any worries that it happens this time?
I mean, my biggest worry is that the Fed arrived too late to the party once again. And by definition, the Fed will always be late to the party because they're data dependent. And the data they're looking at is backward looking. Yeah. The question just becomes, how late to the party are they? And how much damage was done to the economy by keeping short-term interest rates at 5.25% for as long as they did?
Yes.
Now, they got to have a 50 basis point rate cut. That's good. They acknowledge that they were late to the party, but what about looking forward? A lot of people aren't talking about it, but they also increased their forecast for unemployment to end this year at 4.4%, and they lowered their forecast for real economic growth, GDP growth, to just 2%.
This is perfect because our phrase of the day is dot plot, and this kind of gets back to, let's just define it here. I'll do that. It's going to take a couple minutes, so bear with me. But the dot plot is a chart used by the Federal Reserve to show each member's projection for future interest rate. 19 of these members total, consisting of 7 Federal Reserve System governors for the entire Federal Reserve System, and then 12 regional Federal Reserve Bank presidents. So not every Fed regional bank president votes on every monetary policy in each meeting, but they do get their voice heard through these, they're called this SEPs, Statement of Economic Projections. So just your first blush thoughts about the dot plots, are they useful to you?
Take them with a grain of salt.
Yeah.
They change as much as the forecast for the weather does. As we saw coming into this year, the Federal Reserve coming into this year was forecasting a total of 225 basis points in rate cuts by the end of 2026.
Oh, so that's even more, yes.
That was even more, 3 this year. In June, they took away 2 of those and pushed them out into 25, 26. Now in September, they not only cut by 50 basis points, but they brought back another 2 cuts. So what it tells me is that the path forward for interest rates is lower. The total amount of rate cuts, the increments that they do them within, is anybody's guess. Nobody has a crystal ball. Chair Powell doesn't have a crystal ball.
He's very careful to say, he almost says himself, take these with a grain of salt. These are not predictions. These are just, projections by individuals that happen to be aggregated. I guess it comes back to the question, like, has the Federal Reserve gone overboard on communication? They had a big powwow a few years ago around the pandemic time, coincidentally, and they said, yeah, we're going to dial some things back, but has it been enough?
Over-transparency has led to a great deal of confusion because
I'm
now the
confused
market
sometimes.
tries to parse between everything Chair Powell says or doesn't say in each one of his press conferences. Remember, they only update that dot plot chart and their summary of economic projections 4 times a year.
Us 4, yes.
All those other meetings, they just announce what their actions are or not. So we only really get to hear from them 4 times a year. So we're left guessing and speculating in between each one of those meetings and parsing all their words. And then, of course, he comes out like he's the coach of the New York Jets at the end of the game and has to deliver a press conference and account for why they did or didn't do something, or account for why Aaron Rodgers threw 3 interceptions yesterday and the Jets lost.
I just want to hear Powell say, we got to get back to fundamentals here.
wouldn't
Vince
that be
Lombardi?
great?
Yeah.
The dot plot is only like a decade or so old, right? 1 or 2 decades old.
Yeah.
So what was life like before we had the dot plot?
Tell us, Kevin.
Yes. And I've been on Wall Street for 32 years, so I remember.
You know.
So prior to that, it was really Fed chair people such as Alan Greenspan
92
coming out and
Greenspan.
telling us what their thoughts and projections were for the market, serving as the one single voice beat for all of those voting members. The one thing to remember about this dot plot chart, though, as Jared pointed out, each dot represents a different view of that voting member for where they believe interest rates are going to be this year and the next 2 years. But if you look at the dot plot chart, there's no unanimity there. In fact, the dispersion between those thoughts and those forecasts are quite different. So for all of those economists and all of those investors who rely upon the dot plot chart, take it with a grain of salt. It's a good tool, but you shouldn't be making investment decisions on that basis alone.
And why are the dots? They're anonymous, right? But then you hear Fed officials
People try to
speak.
match them up, and it's this big game that people
Yeah.
Right,
do.
but what's the point of them being anonymous at that point?
Well, that's a deep philosophical
Yeah, I
question.
don't know.
They're transparent to a degree.
Average Joe here, just asking a question.
Well, what's
a very
funny
good
is
question.
like way back in the day, this is before I was covering markets, and you go back to the 80s, but maybe even 92, you didn't get a Fed announcement on the day. You had to look at the money supply statistics the following week to infer what the Fed was doing. Were they cutting rates? They didn't tell you. You had to infer
Yes.
that. So now we get like transcripts on a 6-year delay. They had none of that.
Nope.
But I guess to the point that maybe they've gone a little bit overboard.
Overboard, yes.
Can I ask, as a portfolio manager, what do you tell clients about the Fed when it comes to their profile? Their portfolio, profile.
I tend to remind clients that we'll do the job for you trying to parse between what the Federal Reserve is telling the markets. And the Federal Reserve still only has 2 mandates that I'm aware of, unless they've changed their own bylaws, and that's to promote full employment and maintain price stability. So control inflation and keep unemployment somewhere between 3.5% to 4%, depending upon whose definition you use. Everything beyond that isn't within their control. And everything that they do, whether it's use their balance sheet or cut short-term interest rates, is to help achieve those 2 mandates. So let us actually review what they're telling us, and we'll adjust your portfolios accordingly. It's too confusing for experienced professionals to understand and parse through the Fed statements, much less an individual investor.
What about, do you ever look at the Fed in relation to the rest of the world, especially with respect to currencies? Because currencies are just relative to each other. And where I'm kind of going with this is that a lot of the differences between interest rates are expressed in currencies. And we've just seen the dollar kind of screaming higher last week. It's a short-term move, but it's significant. When I see the dollar screaming higher like that, I think, well, what's going on? Because the Fed is cutting, you would think, well, if they're truly leading the way, you'd see the dollar go down. Is this risk aversion? What are we seeing?
The outlook for the Fed being as aggressive as they were with that first rate cut the second time around has decreased significantly following last week's jobs report. In fact, the 10-year right now is hovering back at 4% again.
Yeah, it's above 4 today.
Yeah, and we're barely out of inversion territory because the 2 years at 3.99
The yield curve
once
inversion
again.
was inverted for 2 years, almost a record long time, and now it's not. One more question on Fed transparency. We get all these speeches by Fed officials, and a lot of times they cluster, and a lot of times they just contradict each other. And that's been the case as long as I've been following this stuff, which probably goes back 20 years or so to 2004, 2005. But has it always been that way where you just see the Fed officials kind of tripping over each other's comments? Is it useful?
I don't necessarily think that's a bad thing. We do want them to be independent. We want them to express their own viewpoints and opinions. We don't want them all just marching to the same drumbeat if, in fact, they don't agree with that drumbeat. So I'm not necessarily opposed to them expressing their differing opinions, but to a portfolio manager, it's very difficult for me to get a feel for what's going to happen next if they can't even agree with one another. And the dot plot is just another sign of how much they tend to disagree every single quarter.
Well said. Oh, you have a
I
question?
was gonna say, like, do we put a little too much emphasis on 25 basis points, 50 basis points? Like from here on out, it's a rate cutting cycle,
Yes.
right? If you don't really understand this so much, what do you say to people who are like, does it matter how much?
Yeah, all I would say is that I pull up the dot plot chart and sit down with individual investors, and I explain to them these are 17 to 19 different voting members, and these are all their opinion on where interest rates are going to be. You see how different they are? But also look at it. One thing that we can all agree on is the path forward is down. And if interest rates are going to come down over the next 2 years, as the Fed is telling us they're going to, if yields are lower and inflation continues to moderate, those are pretty strong tailwinds for both stocks and bonds. So let's focus more on the longer term and less on the shorter term.
Very good. We need to take a short break here. Hold that thought. Coming up, we're going to be talking runners up in the AI trade, and we've got quite a few. Plus, for all you quant lovers, we've got a discussion for you on factoring that you will not want to miss. All right, we are back, and this episode is brought to you by the number 7. That is how many industry groups have returned over 20% this year after chip stocks, which are actually number 1 at 70%. So just as a reminder, when we classify stocks at the very top level, we have sectors. Below that, we have industry groups and then just industries. So let me just tell everybody what these runners up are. In media and entertainment, so far in 2024, they're up 30%. Utilities up 27%. Insurance 26%. Food and staples, stuff people need, 26%. Telecom, 24%. Capital goods, like heavy equipment, 24%. And banks, they're just under 20%, but they round up. So a lot of typically boring stuff as far as investors are concerned. Utilities, which is now an AI trade.
Yep.
Insurance, food and staples, telecom. But this stuff is flying. What's going on?
Utilities really are a backdoor play into
Yeah.
the AI revolution. We know these data centers require tremendous amounts of electricity to power all these intensive algorithms, whether it's electricity based, whether it's natural gas based, or what we're finding as of late, nuclear power. And all of these data centers can't manufacture their own power. They have to turn to the utilities of the states that they operate within. So not only do utilities pay generally attractive dividend yields, not only are they generally more defensive in nature, but now they're a backdoor play into the AI revolution. Investors realize that. You see more and more flows going into utilities, but just be careful because some of those utilities are now priced pretty expensive versus the market as a whole.
I'm interested in these individual things, but I have to ask, who comes up with like sectors versus industry groups versus
Oh, it's a very dark remote room somewhere.
I do
Basel,
not like
Switzerland, I'm
this.
pretty sure.
Also, isn't utilities it's a sector technically,
Utilities
and
business.
an industry in an industry group?
So yes.
Both.
So when you look at the broad categories, yes, utilities is a sector. I was pulling this up on a terminal somewhere. I'm going to leave the name unknown, but that's exactly what it's spelled out. So who comes up with this stuff? All right, so we have several classifications. Bloomberg has one. There's one called GICS, which is general. Well, I don't even want to.
Industry classification.
There you go.
This sounds like a job for me, honestly. This
Yes,
sounds like my
Global
next
Industry
gig.
Classification
Yeah.
Standard. So I think we generally use GICS because it's kind of the standard, but yeah, it's just a few people decide this stuff, and there's a lot of wiggle room. Like telecom, you now see in this category, you see its communication services, Alphabet, Netflix, Verizon all together. So it doesn't make a whole lot of sense, but you gotta start somewhere. So that's what we're dealing with.
What are you telling clients? I will get to these other sectors because I know the rally is broadening out, but what are you telling clients about investing in AI right now?
So I'm reminding clients that investing in AI is a long game. If I could draw the analogy to baseball, I would suggest that we're in batting practice of a doubleheader.
Yeah.
That's how long the runway is here. And there's going to be more companies that fail than succeed as they try and align themselves with AI, whether they're an enabler or adopter of AI. So you need to be patient and you need to look past the headlines. I often get asked the question across the country, can you find me the next NVIDIA? And I think that's doing a disservice to the whole theme, because that's one stock, that's a semiconductor and chip, and that's not the only investment opportunity that exists within the AI ecosystem. I could argue right now that data centers are in fact an even more critical component to that ecosystem and offer even more attractive investment opportunities. So
over
build a
long term.
diversified portfolio, don't just look for the one home run.
And are you telling people to get into utilities as a backdoor play?
Absolutely, absolutely.
And capital goods, so we're talking heavy equipment here, but some of that ties into materials and infrastructure.
Yep.
It looks like there are a lot of related plays. Any one that you think might be lagging or maybe a better opportunity on a short to medium term basis?
The one area that I like right now, we know that these data centers run hot. They draw a lot of electricity, right? So they need tremendous amount of cooling, HVAC solutions. So
Interesting.
we found a company called Vertiv not so long ago. No one ever heard of Vertiv. They're in the industrials gig sector. Who would think an industrials company has anything to do with AI? But what do? They supply the electricity, the infrastructure, and the cooling solutions to data centers. And then within Smart Trust, we found two other companies recently that are similar, Modine Manufacturing and a company called Comfort Systems. These are companies that align with the data centers, nothing to do with AI, but the data centers need them to run. It's an interesting investment opportunity. You have to peel back the onion, and you'll find a lot more areas to invest in.
How do you approach investing broadly, choosing between stocks, choosing between ETFs or alternative assets? How do you, what's a little thesis here?
I don't invest in crypto. I still don't understand it. And I'll never put my clients' money into something where I can't explain to them why it moved up or down in a given day beyond just supply demand, right? So what we try and do with each one of our clients is build a portfolio that's consistent with their goals and objectives. Is it income? Is it growth? Is it a combination for each? What's their investment time frame? In other words, how much are they going to be investing this pool of money for? And what's their risk tolerance? We always remind investors, don't just change your risk tolerance. Don't get more aggressive when the market's going up, just as much as you shouldn't get less aggressive when the market is going down. There was a great study done by University of Michigan professors. And for anyone who's listening, I don't know if you like Michigan, Ohio State, I'm staying out of that whole debate. But he looked at 30 years of stock market returns. And what he found was that over those 30 years, 95% of the return of the S&P 500 took place in just 1% of the trading days.
Yeah.
Now, I don't know when those 1%
Well, it was
of the
at the
trading days are
bottom
going to be.
because you get the big 5% days after the big 5% down days.
That's when they occur.
Yeah.
You need to stay invested.
Here, we got to get to who wore it better. And this is one of my favorite segments on the show, so we're just going to dive into it. Quant factors. This is something that we're going to have to define, so I'm going to do this very briefly, then we can get into the discussion. Quant factors are measurable financial metrics used by quantitative investors to evaluate stocks, to improve portfolio performance, and reduce risk through systematic analysis. Hope that's clear, Sid.
I got it. I got it. I just don't love the word quant for all you listeners.
It's just math. So
It's just
basically,
math.
we're breaking down the markets into math terms, and we're figuring out what kind of styles are doing better. So there are many factors. I'm going to give you just a few. Value, as in overvalued, undervalued. Growth, as in strong earnings potential. Momentum, is it moving? How fast? Size, we got large cap, small cap, mid, micro. Volatility, what is the trading range? What is the projected trading range? Liquidity, does the stock have the volume that you need to get in and out easily? And then dividends, are you getting paid to own it? So Kevin, the question for you is, among all these and any other ones, you pick whatever you think, it could be a couple. What do you think is clicking right now? What do you like for investors?
Because I like all those, and we consider all those within our portfolio construction process. We just had an investment team meeting this morning before I came into New York City.
Good timing.
And we were discussing the rotation out of growth into value. As I came into 2024, I suggested my macro theme for the year was an expansion of the rally. Beyond the Mag 7 growth technology stocks into the other 493 non-magnificent or unmagnificent stocks, which tend to be value oriented. So we're looking for those companies that now are trading at reasonable multiple, have strong balance sheets, and often pay dividends. That's the value area. We're not abandoning growth, but we're now taking some of the chips off the growth table and moving it into value.
For someone who has a very long runway, someone in their 20s and 30s, like me, should they be rotating into value, or should they keep with those growth names?
Sure. I don't assume just based on someone's age what their risk tolerance is, right? Because I know a lot of young investors who are very risk adverse. I know a lot of very old investors who are very hungry for and have a bigger risk appetite. So what I would suggest is you build a diversified portfolio and include growth and value-oriented companies, but consistent with what your risk tolerance is right now. We see more value in value going forward, pun intended completely, and we see more growth opportunities in value going forward, but we're not going to abandon growth completely.
And does diversification to you mean invest in all of the sectors at some point, a little bit or a lot? Like, are you supposed to go all in on, not all in, a little bit of everything?
Or just passive, like
Or-
S&P 500 or
yeah.
bust?
So can I use another quant term?
Please.
We'll add standard deviation to the mix,
Oh
okay?
boy, oh boy. I don't know if I like where this is going.
Which is a measure of risk. So what we do is we build portfolios to stay aligned with a certain defined standard deviation over the course of the year. And that standard deviation aligns with the investor's
You must
risk
love
profile.
utilities.
I love utilities, especially for the
Yeah.
more conservative investors. So we're going to choose the different types of asset classes, whether it's stocks, bonds, alternatives, cash, and then within those, the sectors and the areas and the geographies that stay consistent with that standard deviation, but give you the most return potential.
Okay.
So that's how we build it.
And I'm guessing you're going to say diversify within the caps too, right? A little bit of large cap, a little bit of small cap, yeah?
Not necessarily
Not
all
necessarily?
of them all the
Yeah,
time.
okay.
We're overweight large cap right now. We do have some exposure to small cap, but I'm not in the camp right now that thinks a soft landing is guaranteed. I think that is still up in the air right now. And if that is the case, do you want to have that much of your portfolio in small cap if the economy might continue to slow?
Risk of no landing, is that back on the table?
I think it is until we find out more from
All
the
right.
Federal Reserve. And I think we have a big election coming up too, and we don't
Oh,
know
yeah.
the outcomes of that election.
Yeah. Let's get a little personal. Talk
Oh,
to
boy.
us about the inception of your career. No, not that bad. Talk about the start of your career. What was your first job?
So I got my MBA, and I got a job at Lehman Brothers in their management training program. I was able to move into fixed income derivatives, very fortunately at that time. And over my 11-year career, I moved up the ranks to become a senior vice president, CEO of their bank, and CEO of their high net worth product and services group. Everything was going great, and then 9/11 happened, and I was in the financial center that day, and
Wow.
I never went back to our building after that. And my whole perspective on life really changed after that.
Wow. Tell us more about that.
So after that day, we moved into the Citibank building in Midtown. And I don't know if you remember back at that point in time, but they unveiled on 60 Minutes that the terrorists had blueprints for other buildings. Guess what? That was another building. So the epiphany moment for me came. I got out of the subway, 399 Park Avenue, and there was an Army tank parked outside the entrance to our building. That seems odd. There's usually not Army tanks parked outside of buildings in New York City, right? Go through there, the TSA child checkpoints, got up to my office, and my assistant said, "You can't go in your office right now. Today's the day they're installing the bulletproof glass." I said,
And you
know
took
what?
that as a sign.
I took that as a sign. I love what I do. I love the company. I didn't see the writing on the wall. 2008 was 4 years after that. But I want to do what I did closer to home. I had 2 young girls at that time. I was leaving at 5:58 in the morning, getting home at 7 o'clock at night. I wasn't able to be the father that I wanted to be, and it was just getting more complicated. And I was very fortunate to meet one of the partners from Henyon and Walsh's brother at a cocktail party in my hometown. 6 months later, made the decision to move there, and it's been a great 21 years since.
Wow.
Good for you, Kevin.
Good for you. Thank you for your story.
My pleasure.
And we got to wind things down. 24 minutes passes so fast. We want to make sure that you check out all our other episodes of Stocks in Translation on the Yahoo Finance site, as well as the mobile app and your favorite podcast providers. That's all for now. Sending it back.